We're joined by Mr. Nikhil Bhuta, the director of EFC Limited, who joins us now. Welcome to the show, Nikhil. My first question to you, lots happening with the company. But my first question to you, that your subsidiary Egg Design has commenced, commercial operation of furniture. And this marks a backward integration through furniture manufacturing. So give us a brief about how this will shape up entirely for the company. What is the capacity like, and what are the kind of revenues will you be expecting from this particular factory?
Yes, hi, Mahima. Thank you so much. And yes, I mean, specifically coming to your question, yes, this is a very big moment for all of us as at EFC level, because this backward integration will really kind of help us improve the overall margins. Because, as you can appreciate in the managed office business, one of the major capex that goes into is into the developing the entire space, furnishing the entire space and get them ready to occupy the offices for the large clienteles that we offer them on sublease basis. So having our in-house furniture manufacturing division will not just help us to control the quality, control the delivery timelines, and also improves the overall margin at a group level. So this is definitely a significant step for us, and it is really going to make a lot of difference in the overall performance of the company. With regards to the capacity, in terms of revenue, the present capacity that we have installed, we would be able to achieve anything around 300 crore plus at an optimal capacity on a single shift basis. And this year, I think we are looking at from the furniture manufacturing division only, we are looking at achieving a turnover of upwards of 75 crore, because this division will only see about 6 months of operation, because it has just began operation this month. So there'll be 6 months that it will be able to register this turnover. So we are expecting anything between 75 crore upwards as the target for this year from the furniture division only.
Right. So, Mr. Bhuta, 75 crores, of course, in FY25, but your longer term aspiration is to get to that 300 crore, right? So, first of all, I want to understand that what are the kind of margins currently in the furniture business? And like you said that, this will improve your overall margins. So then going forward, let's say from a longer term perspective, where will the blended margins be at?
So specifically, if we talk about the furniture market, generally, I mean, broadly, this industry is set to be a 40% EBITDA margin. We also believe that we should be able to achieve that margin very well. Obviously, in the first year of operation or so, we might not achieve the optimal efficiency, and that's why probably our margin may remain around 30-35%. But going forward, when we are really achieving the best top line in terms of, let's say, 300 crore, at that time, certainly we'll be in a position to achieve a margin of about 40%. On a blended basis, because we have 3 divisions in our company, one is in the managed office business, another is into the design and build, the total furnishing business on a turnkey contract basis. And the third division now we have is this furniture manufacturing business. So all put together, our blended EBITDA margin would remain around 30% odd. And that will be the kind of total top line that whatever that top line will be achieving, our blended margin would be in the around 30% plus.
All right. And Mr. Bhuta, so like you mentioned, now your business has 3 segments. The rental segment was approximately 63%. The design and turnkey contracting was roughly 36%. And now you also have furniture manufacturing. So going forward, what will the mix be like in terms of revenue?
So going forward, if I talk about down the line 3 years or something, our aim is to achieve equilibrium for all the 3 divisions, where all 3 divisions would be contributing almost equally, let's say 1/3 each. Considering that in the rental business is pretty much like a linear business, that if we keep increasing the capacity, the rental flow increases. But there is no inorganic, or there is no kind of situations where suddenly there is a sharp increase in the pricing, depending upon the number of contracts and the number of clientele that you are able to win. So there is such definite potential available both in the furniture manufacturing divisions and the design and build division. So we are certainly looking at a situation where if we are able to achieve 33% for each division, that will be an ideal situation for us, and that's what we are aiming for.
Right. And by when will this happen?
I mean, we believe that this should happen in next 2 years' time. At the
Next.
end of by end of 2 years, yes.
Okay, and then still the blended margins will be at an upwards of 30%, or do you expect a further upside there?
No, blended margin would be in upward of 30% because in the DNB division the margins are relatively low while the volumes are large. So on a blended level, the margins would remain between 30 to 35%.
All right. Okay. You've recently also done a strategic acquisition of Bigbox Ventures, where you've acquired 51% stake. So I wanted to understand the rationale behind this acquisition, and how much does this add in terms of capacity, and what kind of revenue addition will this particular venture do?
So in terms of acquisition of big box, number one, we when we do acquisitions, our philosophy is very clear that first we try to see whether that acquisition is making cultural fit to our organization, because the way we have positioned ourselves in the market, we don't want to get into situations where we do any inorganic growth in a manner where there is a cultural misfit which is happening. So particularly in case of big box, that cultural fit was number one was there. Number two, we were also able to negotiate a good deal with them. We had done a primary investment into the company, and we were able to acquire a substantial and controlling stake in the company by doing that. The company, when we did an acquisition, had about 3,000 billing seats. Now, I mean, after just within this quarter, because we did this acquisition in this quarter itself, and during this quarter only, already the company has added more than 2,000 seats. So how we are positioning ourselves is that if we are able to get such brands who are culturally fit with us, and we are able to invest at a good reasonable margin, then this is going to help us inorganically grow in the managed office business, and this consolidation has to happen over a period of time. So we are always look out for such kind of an acquisition deals where we are able to enter into a company, acquire a controlling stake, where they are culturally fit to us. The business mindsets, philosophy matches to how we work as an organization, and how we have positioned ourselves in the market. And if the similar fit is available, we will certainly look for such acquisitions if they are making sense commercially to us.
Right. And so then, Nikhil, I want to understand that March, financial year ending March 24, you roughly did a revenue of 400 odd crores, right? And you expect this top line to double in FY25. So what are going to be the, levers for, particularly doubling your revenue? Number one, of course, will be furniture and the other acquisition that you've made. What else will be contributing to this doubling of revenue?
So significant contributors, apart from how the managed office business is really growing because of the way the industry is right now positioned. And if you see all the three industry, whether the managed office business, DNB division, or the furniture manufacturing business, all the three industries at present is growing, and they're growing at the best possible rate for those industries. And in terms of the overall contribution, if you look at from each of these divisions, yes, there is an organic growth which keeps happening because we keep adding about 30,000 seats on a year-on-year basis, and that's the target for this year as well. So there will be definite contribution from the managed office business. There will be significant contribution, more than the double that we have achieved last year for the DNB division. And as you rightly said, there will be substantial contribution coming in from the furniture manufacturing division as well. So I think with the contributions equally coming in from all the three segments, and furniture manufacturing getting added as a new division for us, our aim to achieve to double rather the target as it was there for the last year is pretty much looks achievable, and we are almost in sight to do that.
And in terms of expansion, in terms of geography, I want to understand your views there. What kind of geographies are you planning to expand into? What are the inventory trends like?
So in terms of managed office business, it's very clear that as of now, for next couple of years, we're going to focus on the major 9 cities that we talk about for our market. you pick up any reports, and those are the cities which are really doing great in terms of the business requirements, etc. So let's say when I say cities like Pune, Mumbai, Hyderabad, Chennai, Bangalore, NCR region, Kolkata, and Ahmedabad on the Gujarat side. These are obviously the significant cities, and there are other two-tier cities which are coming up. Although we are not really focused on those two-tier cities right now, but obviously, if our clients takes us and clients leads us to those cities, we will definitely expand in those cities. But otherwise, our focus will remain into these major 9 cities because there's still substantial growth potential available in those cities and for the managed office business. And we are certainly focusing on those cities at the moment, except for the client requirements leads us to going to the other two-tier cities like Chandigarh, Coimbatore, Jaipur, Indore, and such other places.
All right, and you've also incorporated REIT, and this is an SM REIT, and with a corpus of almost 500 crores. I want to understand that what is the purpose of this? How will this, add on to your business, and what are you planning to do with this?
So the SM REIT is under. So we made an application to the SEBI. The application is under process, and hopefully, we should get the registration in place in between let's say before 15th of October. Once the registration is placed, the entire business model that is planned under this structure is that we will be in a position to acquire some of the assets where we are right now sitting it as on a leasehold terms. So we can acquire those assets from our existing landlords. And since they are pre-lease property where we are already managing those properties, uh, that will add up to kind of already a rental yield generation happening there. And if you look at the rental yield generation model, typically if you consider it on standard lease basis for a landlord point of view, standard lease basis today the market is anywhere between let's say 6 to 7% at the max that you can earn in a commercial property where you just simply lease out a property as a landlord. But when we lease out this property along with the services, as we do under the managed office model, our ability to generate the better yield becomes much more increasing and much more better. And that helps us become a win-win situation from an investor perspective. From our perspective, what it gives us is that it only differentiate a situation that we are replacing our landlord with the REIT. So now what is happening is the REIT is becoming my landlord and I am becoming the manager of that REIT. And hence I am becoming the manager of that property. So we are primarily getting into the asset management side of the business. And that would help us to have a kind of a perpetual right as long as we are able to perform well for the REIT. As long as we are able to perform and give result to the REIT, we become a perpetual operator. We become perpetual manager of that assets that we are managing, which may or may not be the case if we have just simply taken that property on a leasehold rights. So that would kind of ensure a longevity in my business. That would ensure more control in my business. And going forward, the revenues, the asset under management, everything would increase, and it will help overall to the company from their performance point of view.
All right, and any particular capex plans for FY25?
Nothing major in terms of except for the leasehold rights that we keep acquiring for our managed office business. No any major capex from the furniture division because all those capex have been done at this point of time, and nothing major. And any which ways the DNB division doesn't require any that large capex except for the working capital requirements. So no specific capex plan as of now for this financial year.
All right. Well, thank you so much for taking out time and speaking with us at NDTV Profit. And thank you so much for giving us those insights on EFC Limited.
So much. Thank you.